All right, so today we're going to talk about the overview of decisions you can make, financial decisions you can make in corporate finance setting. All right, so here's our agenda for today. Let's first start by talking about how to think like a finance professionals or academics, I don't know. Well, finance, if you go back 50, 60 years ago to any top universities in the world and ask for the finance department, you won't find one. Okay, if you ask, hey, can you take me to the finance department, please? You know where they take you? They take you to accounting. And when they say accounting, it means accounting in terms of, hey, I have an invoice to place to university. Where can I meet and make that invoice placement? Because finance as a field didn't really exist. But finance has been around for a long, long time. If you read books like Sapiens and so on, you've seen the role of what currency did to the world, how it transformed human societies. Money is about as old as human history itself. So why is it that we don't have a field that dedicates the studies to finance itself? Well, the answer is, well, we already know how to study finance, but in several places. It's divided up in three main places. Would you like to guess where those three places are? Which three disciplines combined make up finance? Anyone? Sorry? Economics, okay, thank you. Why do you say economics? What do we learn from economics? Opportunity costs and so on. Okay, great. If you have to describe economics to someone, maybe your grandmother, okay, that's a good test, by the way. If you want to know your explanation is good enough or not, try to explain something to your grandmother, and if she understands it, then that's a good explanation. So, how would you explain economics to someone who doesn't know economics? What do we study in economics? Anyone from back there, maybe? By the way, you can come closer to the front, maybe in future classes. Okay, we're going to be talking a lot in this class, so the closer you are, the easier for us to get to know each other. Economics, what's economics about? Demand and supply, all right, thank you. Let's take it further. Okay, what about demand and supply? Let's say demand. Okay, what do you know about demand? The higher the price, the less people want, but there's always going to be someone who wants something, right? People just want things. That's human. Okay? You want more and more. If you have something, you always want more. Okay? The reason you say enough is because maybe it's just too expensive to get the next unit. So you say, okay, I'm going to stop. But under normal circumstances, our needs are unlimited. What about supply? If our needs are unlimited, supply, on the other hand, mostly scarce. Right? Resources, we learn in economics, are scarce. Land, labor, capital, and so on. So you can see the connect with economics and finance, because capital, money, is scarce. Right? We have to allocate it to the most productive needs. Economics is about the study of how to allocate resources that we have in limited supply to the most productive uses, so that everyone, at least in our definition, okay, can be happy and better off. Great. Economics. Two more. Yes?
Accounting, of course.
Accounting. Thank you.
Understanding of balance sheets, income statements, and how the relationship between the numbers fits.
Fantastic. Accounting is a language of business, right? You can do business if you like. You can understand business easily in your head. Okay, but it becomes difficult to keep track of things that go on in our own head, right? If you want to know if business is good or not, just go down to the business and take a look. You'll be able to judge for yourself whether it's good or not. But if you have many businesses in many places, it becomes difficult to keep track of things. And that's why accounting was invented, to keep track of things. The word accounting, accountability, they all have the same roots. So accounting, of course, is at the heart of finance as well. Thank you very much. The last piece. We have economics, study of scarce resources. We have accounting, so we understand, keep track of things, measure things. What's the last piece? Give you a hint. In this building contains the answer. A couple of floors down. What's on the 9th floor and the 8th floor of this building? Department of Statistics. Thank you very much. Can you guess why statistics matters? Investment is ... risky. But how do we measure risk? We've seen that in many classes, right? We rely a lot on statistical insights in how we measure, quantify, and manage risk. So accounting, economics, statistics combined become finance. About 50, 60 years ago, people decided, yeah, finance, we know it's important, but it's always at the back of our mind. But finance as a profession hasn't really taken off until quite recently in history. So people said, hey, if people make a career out of it, we better have a science or at least a discipline to support it. So we take the insights from all these places and then combine and say, hey, here's the Department of Finance. Okay, so what that means is what we learn, you're gonna sound very familiar if you covered these concepts from other cases. And that's by no accident. It's by design because we borrow from other sciences to become what we are today in finance. Great. So, how does finance relate to business? You're gonna ask, right? Corporate finance, corporate means business, really. So, how does finance relate to business? Well, let's think about the steps of a business life cycle. Every business starts off as an idea. You write the idea down as a business plan. Yes, but you have to evaluate, is it worth it or not? Feasibility study, that's investment evaluation. Should I invest in this or not? Great. If I want to invest in this, the next question is, how do I find the money? Fundraising, right? You can finance it using debt and equity. Those are instruments. You can finance it using equity from yourself. You can finance using equity from your friends, family, other investors, angels investors, and so on. Those are identity of people you want to raise financing from. So these are the questions you want to ask. Okay. Under what circumstances different types of financing provide advantages or disadvantages? In fact, about a third of this course is going to be about that discussion. Then you invest into productive assets. Once you invest, you have the results. Remember, when you were doing a business plan, that was your imagination. That's what you hope the business is going to turn out. Now is your reality. Now you can measure, have things turn out the way you expected them to. So you can do performance evaluation. We've seen that in accounting. Okay? But there are several metrics you can track, and each metric is meant to measure particular symptoms, particular conditions of the business. Then the business may have risk. Some risk, okay, you have to manage using your managerial skills and so on, but there are some types of risk that financial instruments can help manage as well. So derivative instruments are created as a way for you to manage those risks. And then you have profits. Comes the decision. I have this profit. What do I do with this profit? Okay, I can pay out as dividends, or I can keep and reinvest as retained earnings. Now I keep in the company, reinvest as retained earnings. The cycle completes itself and continues. More investment opportunities. We have even more investment opportunities, but you don't have enough money. What do? You raise funds again. Okay, and that is a role of finance in business decisions. So to successfully discuss the role of finance from a practical perspective, this class is going to require you to think not just as a financial manager, but as a manager in general. I'm going to ask you to try to understand the business that we're analyzing as well. Because part of the reason why some financial decisions are taken stem from the nature of the business that we're considering itself. Okay, so I'm going to ask you to more than just take a role of financial analyst or manager of the company, but try to think more as an entrepreneur or business managers. In fact, as a business consultant. So, imagine running business. Could be your own business. What would be your objective? You can shout out answers. Okay. What would you like to see in your business? Maximum profit, thank you.
Sustainable growth.
Sustainable growth, thank you. What was that over there? We hear something else on this side. We have profit, we have growth. Do we have anything else? Is it wrong to do business because I feel good doing it? If it's your money, nobody's dying if you don't make a profit. That's also fine, right? I want to bring this up because when you run a business, when you have a business, it's actually okay to have objectives that don't just relate back to profit. Right? But in the end, though, we tend to focus on profit. Sustainability, yes, but we tend to drive our decisions back to profit. Why? Again, back to the point about accountability. Most of the time you do business, you're doing business not just for yourself, you're doing business for your investors, that's for sure, but you're also doing business for your employees, for your suppliers, for your customers. Without them, you're also screwed. So you can't just focus on the profit without considering other aspects as well. We had a lot of discussions in the past. Is it okay to have a profit at any cost? Could be, but for people who profit at any cost, they may not be around long enough to enjoy the success forever, because people learn and they don't want to do business with you anymore. If you do a business without profit, fine, but do you have enough financing to keep it afloat? If you have unlimited coffin, be my guest. But if you need to raise external financing, who's going to invest in a business that has no profit? Okay, so profit remains the most important thing. But profit also remains the thing that people perhaps sometimes pay too much attention at, because it's easy. Okay? You can measure profit very easily. Other parts are quite difficult to understand. So people tend to focus a lot on profit in the past. Now discussion has kind of taken a step back. You may have heard of stakeholder theory of management that's gaining popularity in the West. But that's nothing more than let's care about society as well. Family businesses in the past have been doing that all along. So we're kind of back to square one. Here we go, right? That's the format of the usual income statement of business. As you can see, every lines along here, they're also your stakeholders. We focus on profit, yes, but in fact, if we don't look after our other stakeholders, there's no bottom line for you in the end either. All right, so the next question is, suppose we agree on profit, right? Profit may not be the best thing to look at, or may not be the only thing that's not the sufficient thing to look at. Sorry, I changed my words, okay? May not be the sufficient metric to look at. You may want to look at other things too, but it still remains the most important metric to look at as well. Businesses should have profit. If you read classical microeconomics textbook, it kind of indoctrinates you, okay? A firm maximizes profit. That's what it states as if it's fact. Fact or not doesn't matter. We know profit is good for the business, at least, because without profit there's no continuity. So how should we measure profit? If you want to evaluate how profitable a business is, what would you look at? If I have 50 million baht in profit, is it good? If I had to make 10 billion baht of sales to get 50 million baht of profit, suddenly it doesn't sound so good anymore, right? So, yes?
The simplest way is to compute the net profit margin.
Okay, fantastic. Net profit margin, like our example earlier, compares what you've taken in versus what you've kept. Right? Back to this line. Suppose you made 3. You didn't keep much. In fact, you didn't get to keep any at all. That's your net profit margin. Fantastic. That's one way of looking at it. So suppose I told you I sold 100 million baht and I kept 30 million. My net profit margin is 30%. Sounds good, right? But if I invested 10 billion to get 100 million baht of sales, is that 30 million baht of profit good? Not anymore, right? So another dimension we also care about is how much resources did you use to generate that profit, right? So here's one way to think about it. Return on investment. What resources are required to set up your business? Then how much profit did you make as a result of your investment? That's one way of looking at it. You can call this ROI, return on investment, and we scale the profit by the resources required to set up the company. Right, let's do this example quickly. Suppose you are in charge of running Starbucks and you're asked with improving the ROI of the business. What could you do? What could Starbucks do to improve the return on the investment?
Do a marketing and then increase the number of the customers.
Okay, try to sell more, right? Increase customers, attract more customers. How will this impact? Well, as long as we don't have to make any more investments, right? We can keep our investments fixed. Our marketing could be just expenses. If you come in, we're going to pay you some subsidies, like buy one get one free, for example. I don't need to invest anything. I just give them coupon, which basically costs me zero. They come in and buy stuff. I have more profit, same investment. Great. I'll improve my ROI. Anything else? Maybe let's do a couple more, one or two more. Yes.
Can we make our supply chain more efficient?
Okay, and how would that lead to our ROI? Can you give some guidance?
So the investment would be the same.
Okay.
But it's going to be more efficient, so our return increases.
Okay. So let me try to rephrase this. If I can understand you correctly. Okay. ROI measures kind of the efficiency of making profit too, right? Per unit of resources, how much activity, how much profit you're able to generate. So let me see if I understood you correctly. If we improve our supply chain, then for the same level of investment, we can drive a lot more activity. I don't need to, have more delivery facilities or factories and so on. I just get more out of what I have.
Or we can cut down the investment, unnecessary investment.
Fantastic, right? But keep activity, but minimize investment. We can also improve our ROI as well. Good. Yes.
We have price politics, demand, depending on the price elasticity.
Okay, now price discrimination, I guess. For you, if you really need this, here's a price for you, 100. You don't like it so much, right? How about 10 for you to try? If you can successfully do that, figure out the elasticity of demand, then you can try to charge everyone their maximum willingness to pay. That's the basic of marketing. If you've been flying recently, you'll be lucky to find that the guy next to you pays the same price for the ticket, because most of the time, everyone pays different prices depending on when you buy the ticket, right? And that's an example of trying to take advantage of people's different elasticity of demand to try to get the most out of it. Good. So we see the idea. So thank you very much. We get the idea, right? We get the idea. But how do we translate this into something quantifiable? Like when we say return on investment, what number? How do we calculate that exactly? You've heard of ROA, you've heard of ROE, and so on, right? And they all have their advantages and disadvantages. Well, let me tell you this. If you work in management consulting, McKinsey, BNP, BCG, and so on, you would never hear the word ROA and ROE at all. Why is this? Don't they measure things like return on something? They do, but they don't use return on equity. They don't use return on assets. They use return on what's called invested capital or return on capital. I'm going to tell you later on why. But let's imagine if we use ROE, we have two identical businesses. One uses debt, the other one uses no debt. Let me ask you the question in two steps. The first step, identical businesses, same sales, same cost structure, same assets, and so on. The company that uses debt, that borrows money, compared to the company that uses no debt, which one has more net profit? No debt, right? Thank you. Because if you have debt, you have one additional line, interest. Other people don't have this line if you have no debt. So if you have no debt, you can have more profit. Now, the next question, ROE, return on equity. The company that uses debt versus no debt, which one has higher ROE?
The company with debt.
Because even though you have lower net income, you don't use as much equity. Lower net income, but even lower equity. So when you calculate this as a percentage return on your resource, it's higher. So all else equal, if the business is exactly the same, then if you have debt as shareholders, you're going to have higher rate of return. And that's the nature of leverage. We've seen this in many, many cases. I say all else equal because when you have leverage, you're introducing the fact that you're going to be adding risk to the company. Right? As shareholders, you have to accept that you're now in a riskier company compared to a company with no debt. But if all else equal, you're going to be much happier if you're owner of a company that has debt. So ROE is not a good measure of business performance, because ROE is a measure of shareholder performance, which depends on two things. Number one, how well the business does, and number two, the capital structure of the business, how you finance the company. You can't use it to benchmark, and different companies have different financial policies. So you can't compare a company's ROE and say, hey, the company with higher ROE is a better company. That's just not the right metric to compare. So that's why ROE is never used, okay, when you do benchmarking for management consulting. What about ROA? Why don't we use ROA? These two companies, the one with debt has higher ROA, the one with no debt has lower ROE. But ROA is profit divided by assets. They have the same assets, right? So shouldn't they have the same ROA? What do you think? What's the formula for ROA? Something over assets, but what's that something on top? Yes.
So it's the weighted average of the assets from last year and current year.
Okay, that's what is the bottom, right? Thank you. The assets. So we do have the assets. We have these two companies, exactly the same assets. What about the number in the top?
Net profit.
Thank you. Net profit. Are the numbers the same for these two companies? We just answered, right? They're not. If you have debt, you have lower net income because you have interest expense. So what's wrong with ROA? Well, you're using shareholder profit. You're dividing it by assets, which is financed by everyone. Then what are we measuring? Doesn't make sense. These two companies, the company with debt will have lower ROA. Mathematically, even though these two companies are identical. So if you want a metric for benchmarking how well a business does, ROA is not a good job either. So let me summarize. ROE not a good job because it's not about business, it's about the shareholder. ROA is still not a good job because even though it sounds like it's for the business, it's not exactly calculated properly because you use shareholder net income divided by total assets, a mismatch. So what do? The answer is, if our definition is wrong, we can recalculate. So to recalculate, let me give you a little overview, okay, of the steps required to move from financial accounting ratios, okay, to a business performance ratio. If you have a business and your business has 100 million baht of total assets, do you need to have 100 million baht of capital to finance it? And when I say capital, I don't distinguish between do I borrow from the bank, okay, do I use my own money, do I use my parents' money, do I use my friends' money? These are all capital, these are all investors. Do I need to have 100 million baht of investment capital in order to finance the business? Let me give you a picture. Left hand side, okay, is a picture of a financial statement, the balance sheet, statement of financial positions that tells you what are your assets and what are your liabilities and equities and so on. And you learn this from accounting classes, the accounting convention. Okay. Current, non-current. Current means, well, it's something very liquid, something that is very immediate. For example, if it's current liabilities, you got to be paying this within 12 months. And that's the guideline used. Right? If you pay this beyond 12 months, we're just going to call it non-current assets. Non-current liabilities. Assets as well. If it's very liquid, we can call it current assets. Okay? If it's not very liquid, for example, go back to this picture. If you look at the store, take a picture of this store. Come back one more next year, take a picture of the same store again, and whatever you see in the picture, if it's exactly the same piece, like the storefront, okay, like the cashier, decoration and so on, that's a non-current asset. It doesn't change. If you take a picture, looks like it's there, but that drug, that medication, that box, is not the same box anymore. I know it's the same brand, but the old one has been sold already. That's a current asset. Okay. You have it, but it's a type of things that come and go. That's an easy way to understand what these are. And that's what accounting does, because the goal of accounting is accountability. I want to see what I have at different points in time. Okay, if you take a deeper look into the items, let's start from the right-hand side. Okay, so as you notice, some of the items I colored in red and I colored in blue. The most conflicting box is top right corner, current liabilities. In that box, we have liabilities. Anything we have to pay within 12 months are classified within that box. For example, accounts payable. Here is our supplier. Okay, we've taken delivery of their goods and services already, but we haven't paid yet. So this becomes our accounts payable. We have to pay. Is it something we owe? Yes, we do. We owe. So it's a liability. Accruals, okay, the wages and so on that we haven't paid to our employees. Why haven't we paid? Well, the day that you close the account is actually not our payroll day, so we still have accrued expenses that we have to pay. Okay, great. These happen because of our business decisions, our business models. If you paid your employees every day, you will not have a wage accrual. Okay, because at the end of every day, you pay. But if you pay every week, every month, as long as your account closing date and your payroll date are not the same, you will have an accrual. In fact, there's an interesting podcast, Planet Money, recently that talks about reinventing how people pay employees. A lot of the financial problems that occur because when you as an employee don't receive money every day, sometimes you face expenses that you didn't foresee, but you don't have money for that expense, so you're forced to go to sometimes even shadow lenders that are very expensive. But that's because you are liquidity constrained, you just don't have the money. So they said, why not pay the workers every day? In that case, they don't have to resort to, like in the US, they call this payday loan. They call this payday loan precisely because your payday is 7 days from now. You need money today, borrow from me and pay back when your paycheck is out, right? So I want to point this out because that's a business model decision. Because of this business model, we have these items on our balance sheet. The fact that we have accounts payable is because we pay our suppliers late. If you pay our suppliers in cash every time we take delivery, we have no accounts payable. What about the red items? Notes payable, current portion of long-term debt. We owe money because we borrow money. The reason for the existence of those items are not because of business model. These are financial strategies. I want to finance this business using debt. Therefore, I have those red items. If I want to do the business with zero debt, I would have none of these red items at all. So if we reorganize our balance sheet, keep the reds and blues together and the rest we just delete. We know the balance sheet must balance, so if we delete the black stuff on the right hand side, we have to delete the same amount on the left hand side as well to make it balance. So the right hand side balance sheet now tracks a similar picture but a different interpretation. Right hand side first, debt and equity, those are sources of capital. Okay, I raise capital from wherever I feel best for my business. Why do I raise the capital? Because I want to open this business. So how do I use my capital? The capital is divided into two components. The first component is a long-term asset, the store. The second component is the working capital. Okay, I like to use retail example because it's the clearest. Okay, you want to open a store, what do you need? Sorry, when you want to have a retail business, what do you need? I need to have a storefront, okay, so people can notice me. Then I buy stuff into my store. How much do I buy? Well, I can buy a lot, but I don't need to have a lot of capital if I buy and then I pay later. That's my business model decision. Okay, I want to finance my inventory using credit terms. So my working capital requirement won't be very heavy. On the other hand, I want to have a store that has a lot of variety of goods and services. So I have to buy a lot of products to keep it fully stocked. So my choice of business model will require me investing heavily in working capital. Fine. I want to sell my goods to my customers and give them 30, 60 days to pay too. Well, where do you find the money? You finance it. So your working capital is financing the sales of other customers. If I want to have a different business model, say I do an online store instead, then my net long-term assets may not be as big. I can spend more on inventory instead and carry a larger variety of goods and products. That's precisely what Amazon did when it started. I have a bookstore, but bookstores are usually placed in good locations. In good locations, there's a high cost of investing in those fixed assets, and there's also a limited space in which you can carry your books. You can't have every single book that you want, because if this is a book that nobody wants, or maybe one in every 4 months, then it's not worth keeping that book. But now I don't need a storefront. I just operate out of my garage. I can buy as many books I want because the storage cost is almost zero. I don't have any opportunity cost of space. I can invest in working capital instead, but have very slim long-term assets. In the old days, people didn't want to do that because where are the customers? I open the store, I have fixed assets because I need to put myself in front of my customers so they can find me. Jeff Bezos said, don't worry, they can find me using the internet. So I don't need to pay for that location anymore, and so on, right? And that's reflected from the financial manager point of view in this picture. So I'm going to call this invested capital. Okay. The capital that you raise, say, if this store has an asset of 100 million, your business model may require you put up only 60 million. Because even though I have all this inventory, I don't need to pay. And so on and so on. I have my business model that allows me to only use 60 million baht of capital to do this. So my 60 million is going to go toward working capital and also long-term assets. That's my uses of capital. What about my sources of capital? Well, it's going to be debt and equity, broadly speaking. But within the debt, I'm going to have some long-term debt. I'm going to have some short-term debt. Within equity, I'm going to have some common equity. I'm going to have some preferred equity. Some of my preferred equity may be convertible as well, and so on and so on. But that's just your choice of financing. You can call this capital employed as well. Sometimes I raise a lot of financing, but I don't use it yet. Fine. If you haven't deployed it yet, it's just going to be part of what's called an excess cash, right? Suppose you imagine you are a big tech company like Grab, okay, WeWork, for example, raise billions at a time. Investors give you $2 billion. You're not going to use that all at once. I'm going to use it over time. But they already gave you the $2 billion. Where is it? It's going to sit in your bank account called excess cash. And then when you deploy it, it's going to be converted into the capital you invest and so on. So when we evaluate how well the company is doing, okay, we want to evaluate the capital that the company employs. And when we say capital, we want to be more specific that it's going to be the capital the company actually deploys already. If we have cases like Grab, for example, it has a lot of cash on hand but it hasn't deployed yet. When we measure the profitability, we're going to have to exclude the undeployed cash because that's not your resource. That's not part of your business yet. Okay, so we're going to take particular care in evaluating the cash position of the company. Sometimes companies have a lot of cash. We might not want to include that as part of working capital, or in fact not include all of it, just the ones that you think are relevant. Okay, so once you divide it up into this picture, the decision of financial manager becomes a little clearer. Okay, left hand side, your investment decision. This is my capital that I'm going to invest. I'm going to invest in some whatever business. Is it worth it? Here's my financing decision. How do I break down the 60 million that I need? Where do I go? What is a better combination for me? We talk about some of the consideration and frictions that may affect your decision making as well. Working capital management, risk management, and so on. Okay, so these, if you go to any textbooks, are the 4 key decisions that a financial manager has to face from the perspective of business. So we can put things together. Okay. The ROA was bad because we had net income divided by total assets. So the bad part was net income. Great. So we're going to change net income into a metric that is now independent of financing. What that means is if you have debt, great. We're just going to pretend you have no debt. Let's remove the interest expense line altogether because that has nothing to do with your business. Focus on the EBIT, earnings before interest and tax, because everything else that comes after that is not about your company's business model anymore. It's about, number 1, your financial choice, and number 2, which jurisdiction you're located in. If you're located in a high tax jurisdiction, you're going to have to pay high tax. That's unavoidable. I'm not going to count that against your performance. So we have what's called a NOPAT, okay, net operating profit after tax, which is essentially a net income pretending you have no interest expense. Mathematically, it's just EBIT times 1 minus tax. That's your numerator on top. Now, we're going to change the numerator, might as well change the denominator too. right? Because we just said assets doesn't really reflect your investment decision. If I have a 100 million baht business in terms of assets, doesn't mean I put up 100 million baht worth of capital. So when you make an evaluation of your investment, just keep to the capital that you're deploying. So let's rescale in the bottom. Instead of using assets, use capital. And now we have a metric called return on invested capital. And if you go to pages like McKinsey and so on, they can use this extensively to try to analyze business. Other names you may see, return on capital employed, ROCE. That's just to say that sometimes left-hand side uses of capital, we call this invested capital. And then the sources of capital, we call it capital employed. But in any case, they're capital anyway. So you might as well just call it return on capital. Doesn't change anything. That's one thing about finance. Okay, we have many names for the same thing. Sometimes because we have different perspectives, right? Required rate of return and cost of capital are precisely the same thing. Required rate of return is, as investor, I'm going to give money to you. This is what I want. You better deliver this to me. Otherwise, I'm not going to give you the money. From the firm perspective, once you raise that capital, that's your cost of capital. That's what you have to pay to investors for them to be satisfied. But it's the same thing, two sides of the same coin. Same situation here. Invested capital and capital employed, precisely the same thing, depending on whether you want to look at this from the investment perspective or the financing perspective. So we have ROIC, ROCE, and ROC, which are essentially exactly the same thing. It's a better metric because one, okay, you can do a deep dive analysis. Okay, you said earlier, you can look at profit margin. You can also look at efficiency. In fact, both of these are the important components of ROIC. This is inspired by a Dupont equation. The Dupont equation that we've seen is built on the ROA relationship, net income divided by total asset, and then modified using sales divided by sales. Here we have precisely the same thing, but instead of using net income divided by total asset, we have NOPAT divided by invested capital. Then we do the same rearrangement and get profit margin and capital efficiency. You could drill down even further. Why does a firm have good profit margin? Well, it either has a lot of sales and or low cost. So if you want to find a strategy that drives profit margin, it can be a price increasing strategy. It can be a volume increasing strategy if your cost structure is fixed. Right? I have the same cost anyway. If I want to increase my margin, just sell more. Then my margin is going to improve. I can improve my margins by increasing my cost, but making sure that by that additional increase in cost, I can sell this for even higher price. You know what's the difference between a high-speed printer and low-speed printer in the old days? A microchip that makes a high-speed printer slow. So let me put this by you again. If you bought a printer from the printing companies in the old days, the cost of making a slow speed printer is higher than the cost of a high speed printer. It is naturally fast. You add a microchip to slow it down. You're like, what the hell? Why do you need to make that? Because if you make one version very fast, then you're going to have very fast for everyone. If you want to have someone, okay, that pays for speed, you better have two versions. One that's very fast and one that's very slow. Customers don't care, actually don't know how much it costs. They pay for the benefit, right? So as long as you have two products, even if you make the worst product more expensive, I can sell the cheap product at an insane price. They'll pay anyway. Okay? That's how you can improve the margins. And some of the ideas people use in business, I highlight for them for you to see over here. Down here we have the capital efficiency, and we can divide capital into working capital and the long-term capital. Okay, when we have long-term capital, we have keywords such as utilization management. That essentially just means capacity utilization. If you have a store that could sell more, but right now we're just not selling enough, then can we drive more sales to that store and close the ones that are closing down? If you have ATM locations that people are not using at all, an ATM is expensive, so why put it there? Maybe relocate it or even just stop having ATM after all. Okay, and those ones are clearer. That's the benefit of the ROIC calculation, because now you have a clearer picture of what do I need to do in order to improve my ROIC. In the old days, we talked about ROA, but it's not that clear about what do you need to do exactly to improve ROA. Here is a bit clearer. And consultants like this, because you can break things down into trees, sub-trees, and then think about how exactly do I go about doing this. All these smaller points I put here, you can imagine them as smaller sub-trees that branch out of these. And then once you have many options, you can see which one you want to prioritize and so on. All right, so economic profit. Now we're back to economics again. Economic profit is the measure of business success. What's the difference between economic profit and accounting profit? How does an economist think? Maybe at the back. We haven't heard so much in the back. I can walk through so I can come directly to you guys. Economic profit versus accounting profit. Let me give you an example. If I open my business and I have a profit of 200,000 baht today, this month, is it good? 200,000 baht profit today, this month. So that's what? 2.4 million baht per year profit. If I told you this is a coffee shop, good. 2 million baht from selling coffee. You ask people who sell coffee, they say, oh, if you make a profit, that's pretty good already. Most of us don't even make a profit at all. So 2.4 million, not bad, right? But what if I told you, before you open a coffee shop, you were a high-ranking executive of a company getting 1 million baht a month in salary? Then making 200,000 baht a month suddenly sounds like, wait a minute, what are you doing? You're getting paid 1 million a month, and now you want to do this, right? And that's what we need to know, whether it's good enough or not, right? We know high profit is good, but how do we know is it good enough? Fortunately, economists give us a way to think about that. Opportunity cost. If you were selling coffee and you were getting 200,000 baht a month and you were told, well, you could have done something else, that's not a fair comparison, right? Because being a CEO versus opening a coffee shop, that's not an apple-to-apple comparison. They're two different businesses. So one way to benchmark this might be, okay, if you got 200,000 baht a month, for other people selling coffee just like you, what are they getting? If they're getting 300,000 baht a month, then you suck. 200,000 sounds good, but other people are getting way more than that. So that's bad. Okay? And that's how economists think about economic profit. If you want to be doing this, you want to be using this resource, the profit that you get from using this resource should have been 300,000 baht. The fact you only got 200,000 means you're making an economic loss. Okay? In other words, what you get, you have to be benchmarked against what you're supposed to get. And what you're supposed to get has to be a little more careful because it has to be an apple-to-apple comparison. And the closest one would be here, right? Other coffee shops would be a good benchmark for you. But how much are we supposed to receive? I mean, how do you know how much a coffee shop is supposed to make? Can you help me with this? High risk equals. We hope so, right? Thank you very much. We hope high risk equals high expected return. But we've seen in finance theory that not all risks are priced. In fact, the capital asset pricing model is, in fact, any asset pricing model, the goal is to find out, number one, what risk should be priced. What are the sources of risk that we're talking about here? And number two, once we know what risk should be priced, what's the price of risk? If you say this is risky in this dimension, then how much more should I be getting? The CAPM is the simplest model because it says, okay, the most important source of risk is the market risk, the undiversifiable risk. So if you're exposed to this type of risk, you can measure the amount through the beta. You know the price. The market risk premium is the price of risk. You can figure out how much you're supposed to get. We have other extensions of asset pricing models. Okay, Pharma French, 3-factor, 4-factor, 5-factor, 6-factor, whatnot. These are just saying that, okay, we know We want to reward people for taking on risk, but what are the risks that we're talking about exactly, and then how much we should be expecting. All this to set a benchmark. So now that you have a benchmark, you can evaluate, is this a good investment decision or not? And that's the summary, okay, of the asset pricing model. So you're going to see many names in finance that we talked about earlier, required returns versus cost of capital, that talk precisely about this type of numbers. This is numbers that dictates how much we're supposed to be getting, and is determined by risk. Discount rate, hurdle rate, same name, right? Just describes how we use that number. Discount because we use it to do present value calculation, discounting. Hurdle because we want to use this as a minimum required return for us to clear in order to proceed with the investment decision. Great. But we measure profitability. What if the company is not profitable now? Do we want to invest? Some people may say no, but if you say no, then you're precisely saying no to companies like Google, Apple, Facebook, Amazon, Grab, Uber, and so on. In fact, Uber isn't even profitable today. Yet people pour money into that. And we all know, because we are finance practitioners, we know that, well, if it's not making money today, as long as at some point it makes enough money, it's going to be good enough, right? So we have to find ways to assess that. And that's how the discount rate becomes central in time value of money, because the discount rate incorporates two things. Incorporates, number one, how impatient we are, right? The risk-free rate describes how impatient we are. We're going to be getting money later. Okay, fine, no problem. Just give me some benefit to compensate, because if I don't have my money today, it means I can't consume today. I have to give up consumption, so give me some benefit too. But if you're going to give me money later, and that money is also uncertain, then you better give me more than just whatever I told you, because with that uncertainty, I'm a risk-averse person, so I'm going to need to have some compensation. So finance theory talks about how to link, the risk aversion theory, von Neumann, Morgenstern, expected utility, and so on, and incorporate that into the framework that we know today. In fact, had it not been von Neumann and Morgenstern, we would not have modern finance as we do today. I think it's one of the least talked about but very important concepts in finance theory that brings us to where we are. All right, so time value of money. But essentially, what does value mean? The fact that we do discounting and so on, what are we doing precisely, intuitively? Okay, let me ask you a question. If I have a bottle of water, I don't have one as a prop. Actually, I do. Fantastic. I'm going to open this up for an auction. How much are you willing to pay for this bottle of water? Anyone? Any start? Was that 7? 7 baht. Oh, very precise, 7 baht. I have no change for you. Is 10 okay? Anyone more than that? More than 7? More than 10? No more? You guys. The tap water is now brine, it's salty. You should be drinking bottled water instead. Okay. All right, so let me take you for a little walk to desert together. Okay, don't bring anything. Okay? You have water today? Just bring yourself and come with me. 12 hours. I still have the same bottle of water. Okay, let's open up to the auction again. How much for this water? I have just one bottle, by the way. Anyone more than 10, 11, 12? All right, you see the point, right? In some classes, I have answers like, I don't need to auction, because whoever get the auction, I'm just going to steal that from him. Okay, fine. Kind of just be thankful we're not talking ethics in this class. But you'll get the idea, right? The same bottle, exactly the same bottle, in different place mean different things. And that's what valuation means. Okay? Under different circumstances, value can be very fluid. It can increase, it can decrease, it can be very subjective, it can be very personal. In finance, we're not allowed to be personal, because we talked about this earlier. We're not making decisions just for our own benefit. If it's your money and your money alone and nobody else suffers from this, do whatever you want. But if you're accountable for other people too, then you better have some common metric of evaluating it. So you find values. Right? In fact, I should have said this earlier, but I think it's all clear, right? A lot of times we see price in markets. but what we really care about is value, right? Like that bottle of water. If in the early example, you were able to win an auction at say $1 million per bottle, is that expensive? No. If you buy something, it is never expensive. If it's expensive, you wouldn't have bought it. That's how at least economists think about people, right? People buy things because we think the price tag is lower than what we think it's worth. Otherwise, if it's worth less than the price, nobody's going to buy that stuff in the first place. You may complain it's expensive, but in your own mind, it's not expensive. If it's really expensive, you wouldn't have bought that in the first place. So price is what you pay, value is what you get. Now, the intuition is clear in everyday consumer market, but in finance, it's pretty difficult because, how do we come up with valuation? When we do valuation, we base valuation based on what? It can't be our personal preference anymore, so it has to be based on something that's tangible. So we end up relegating ourselves to profit. Some people say, okay, profit, great, but you can't touch profit. You can have a really profitable company, but haven't collected any of the sales yet. And you can go bankrupt because you have no cash on hand. So we also say, then let's focus on cash flow then. In fact, you can focus on for profit or cash flow. It doesn't matter because the two things, they're the same. Profit and cash flows are the same. If you can get cash earlier, it means you're taking future profit today. If you have profit today, but you can't get cash, it means the profit that you have, you invested in something. So it's not the right time for you to take it out yet. If you don't believe me, wait until we do the financial modeling together, maybe next week, I guess. Then I'm going to show you profit and cash flow, they're related by investment. Precisely speaking, profit minus investment equals cash flow. Okay, and I'm going to show you using formulas that we're familiar with, and hopefully this will become clear that it's as intuitive as that. Okay, so what does value creation mean in finance? Looks like I'm running out of time. I should have taken a break already. So here is what you know. I'm going to skip this. NPV, IRR, you can read this by yourself, no problem. All right. So that's just a brief overview of what you can expect to see. The cases that I pick out for you will be cases that address some of these issues. I don't think we'll be able to touch on all of these. We may touch on some topics more than others, but the broad decisions we can be making is going to be like this. So the most important thing is finance helps you make decisions. And to make financial decisions, it boils down to just a simple question of, is this decision creating value for me? Right? Is it worth it for me? So in the simplest example, if we had that 60 million baht drugstore, if it cost me 60 million to invest, am I getting a store worth more than 60 million? If I find that the value of the store is 75 million, I pay 10, the price, that's worth it. The in fact, let me talk about this a little bit more. The NPV calculation that we do is nothing more than value minus price. Okay, your benefit that you get minus the the resource you have to commit to invest today, is it net positive? If it's net positive, it's great. Why do we just want positive? Why don't we want a high number? Because if it's positive, remember discounting? Discounting already incorporates the return that we want. Okay, we reduce the value investments by the rate of return that we want already. So even with that discounting, if the value still exceeds the cost of investing, it means we're getting return that's beyond what we want. So you can do this yourself with the example I gave you. If you have a positive NPV, you're going to have an IRR that's greater than your cost of capital, because they mean the same thing. They mean the same thing under most circumstances. So that's why we tend to use those two tools to help our decision making. All right. So that's a brief overview for today, okay? And we're going to be going over more and more details as we go through the class, especially in the sections that I designate as lectures.